Hello. I'd just like to say thank you for your support and thank you for being here. And hopefully, in this series, I'm going to be breaking down a lot of ICT's concepts into small, manageable, bite-sized chunks in these video format tutorials. And there is a lot of information out there for ICT. There is a lot of stuff on his free YouTube. But it's very, very dense and there's a lot of information. So the idea here is just to make things easy and simple, especially for newer traders to follow. If you're here, I'm sure you already know my name is Ali Khan. I've been under Michael's wing for the last 4 years in his private mentorship. I'm just here to really educate and hopefully people will get some benefit out of this. So anyway, let's get into it. So, the algorithm. What is the algorithm? The algorithm, as Michael refers it to as IPDA, the Interbank Price Delivery Algorithm, is basically a computer program that's job is to engineer liquidity in the markets by moving price. And it isn't buying and selling pressure, right? What we were taught as buyers and sellers coming into the market and there's this constant tug of war is actually not true. There is an algorithm that moves this price. And what it does is it creates these old highs and these old lows, and these peaks and troughs is where we're taught to put our stop losses. These peaks and troughs is where all the liquidity is basically held. So because the algorithm in its programming logic is based on human emotion, and its whole job is basically to manipulate price, we can see this manipulation in these old highs and old lows. Now, when you can understand what the algorithm is going to do, you can predict future price. And this is what ICT concepts are all about. It is about what the algorithm is basically trying to do. How does IPDA work? So the central banks created IPDA. The money is their commodity. Now they can set the price of that money because they own the money, and IPDA, which is the algorithm, will dictate what price of that money is basically going to be. Retail money is a liquidity, so they're looking to seek retail liquidity. They'll engineer the liquidity, retail money floods into the market, and then they devour them. And that's the whole purpose of what IPDA is. It is made for the banks, it is created for the banks, and they don't want you involved. So when you understand this, it makes things a lot easier for you to digest and say, right, this market is too big and the banks are too big. We cannot fight them, and even if all of retail got together and put money into the markets, we're just a drop in the ocean. So the best we can do is basically piggyback on what the algorithms and what the central banks are basically going to do. There are times where the central banks can actually reprice and there's manual intervention where there is an actual market maker behind the scenes where he will push buttons, and you will usually see this either through Black Swan events or you will see this through FOMC, NFP, like high impact news drivers, which by the way is also a part of the whole manipulation and the whole smokescreen. The move has already been priced in beforehand. And these news events that come out, these are just a smoke screen to say it doesn't matter what the news is, whether it's positive or whether it's negative. They've already made their mind up and they know where price is basically going to go. They just reprice it themselves manually to get there. But when you understand this and you can work it out, you can sort of expect where price is going to go based on understanding that, okay, these news drivers are a manipulation event. So IPDA, its job is to deliver price efficiently to buyers and sellers in the marketplace. So there's a whole efficiency paradigm what works within the algorithm's logic, and it has to go from buying to selling and selling to buying, offer price in both directions. There are two main ways IPDA does this. Number one, to rebalance inefficient price action. And number two, seeking liquidity. So offset distribution and accumulation and the pairing of orders. So what does this mean? Number one, rebalancing inefficient price action. What we can see in this area over here is prices moved too quickly to offer any buy side delivery, right? So all of this this was just sell side delivery. This is all selling. The market moved far too quickly to offer any buy side delivery. So this is known as sell side price displacement. So this is all buy side inefficient price delivery. And now what the algorithm is going to do is offer buy side delivery, and it will fill out this inefficient sell side delivery, right? So the job is to basically offer buying and selling and keep this market efficiency paradigm where we're selling over here and then we're re-offering price, because this is very porous price action. Okay, so it's just this exchange between buyers and sellers, and IPTA's job is to basically keep the algorithm moving and keeping offering based on fair value. This went down quickly and is going to go up to rebalance and offer fair value, then come back down again. And number 2, offset distribution and accumulation. So this is known as the pairing of orders. So as you can see over here, the algorithm has held this range, right? And in this range we have accumulated buy stops and sell stops above and below the market price. Now this is all buy side liquidity, sell side liquidity, and the market's been held into this range, and this is the manipulation part of the algorithm. This is what it will do. It will hold it into its range until maybe a news event will come out. And this news event will be used as a manipulation driver to push the market in one direction, thus taking these buy stops. Now, when these buy stops are triggered, these are willing buyers in the market. And as the buy stops are triggered, these are now active orders, right? So the algorithm will push price higher to activate these orders. And then what it will do, it will change direction, right? And it will come back down. And the buy stops that were over here, these will be distributed down to the sell stops over here, right? All the sell side liquidity has now been taken, and these orders, which were sell stops, are now paired with buy orders, and these are then distributed back to the buy stops above this high. And then the buy stops above this high, they're paired with sell orders and distributed back to the sell stops, which are willing sellers in the market. This constant ebb and flow of the market is the real underpinnings of how the algorithm works. It's to generate and engineer liquidity and then manipulate it, and then to pair orders with short positions if they're buy stops, and then take the market down, because there are already willing sellers in the market down here and there's willing buyers up here. So they will sell to the buyers and buy back from the sellers. Understanding this will propel you already light years ahead, because you will understand that, okay, when the market's in a range, let me see what it's reaching for. And this constant ebb and flow, you can, in between these, you can really find some really nice trades. How does IPTA work in its data ranges? 20 days, 40 days, and 60 days. It will start with 20 days in the past, and that's where you want to look at your first data ranges, where the highs and the lows in the last 20 days. If the highs and the lows in the last 20 days have been taken, look at what the highs and the lows are in the last 40 days, and then the highs and the lows in the last 60 days. I'd like to say thank you for watching. This is the first part. I hope you found this insightful. I wanted to keep it quite concise and really get to the core points of what we are looking for and what the algorithm does, and sort of give you a little bit of background about it. In future videos I'll be going into a little bit more detail about these inefficiencies in price, and I'm delving a little bit more into what the algorithm has in its logic and way of price macro points, and we'll discuss this in a little bit more detail. So hopefully I'll catch you guys in the next video. You take care.